Hi, welcome to podcast 2 on bank reconciliations. Where we're up to at the moment is we've updated the cash book. So what we've done is we've gone through and checked off all the items that appear in both the cash book and the bank statement. So we've ticked them off. Got to remember that in the bank statement, we make a credit entry whenever we pay money in. And that's because the bank statement is issued by the bank and it's from their accounting records. So when we pay money into the bank, for example, $1,050 for the bank, that increases the amount of money that they owe to us. And similarly, when we pay money out of the bank, so Ahmed here, $305, that's a debit for the bank because it's reducing their liability to us. Identify some items which weren't ticked off of the bank statement because the bank statement is, if you remember, is a source document. So we didn't know, for example, about the direct debit for fuel until we received the bank statement. So once what we've gone and done is we've gone through and we've put those entries in, we've rebalanced off the cash book, and that shows us that we believe that we've got $840 as an asset in the bank, so it's not an overdraft. Okay, what we are missing is a few items which still aren't ticked off, and they're items that appear in the cash book but not on the bank statement, and they appear there for one of two reasons. We've got unpresented checks. These are checks that we've sent to a supplier, but for whatever reason they're not processed. We call the term cleared by the bank and therefore don't appear on the bank statement. So the reasons for that could be that it's in the post, going to the actual supplier, or it could be that the suppliers put it into their bank, but it takes time for their bank to contact our bank and to actually ask for that money to be transferred. So there's always going to be a delay. There's also another possibility, and that's to do again with the delays between the bank. But when we go and put a check, particularly, but also cash into the bank, it's got to go through their systems before it's going to appear on a bank statement. Right, looking at how we actually do a bank reconciliation, there are two ways to do it. You can either start with balance as per the cash book or balance as per the bank statement. But the idea of a bank reconciliation is that we find out why there's a difference between the amount in the cash book and the amount in the bank statement. So way one, if we start with balance per cash book, we're going to add unpresented checks. So we're going to add to the balance as per the cash book all the amounts that we think we've paid to customers, in this case 480 and 270 to Jitan and Roberts. The reason why we're going to do that is in the bank, they haven't yet taken that money off. So we've taken it off in the $840, but the bank haven't. So we need to add it back onto our figure from our cash book. It isn't money that's actually gone out from the bank yet. Similarly, you've got the amounts less the amount not yet credited. So we're going to take this 345 and 340 away. And the reason why we're going to do that's money that's gone into our cash book. So we think we've got the money, but the bank don't think we've got it yet. So our figure is going to be too high by that $585. And when we do the two adjustments together, that shows that the balance as per the bank statement should be $1,005. Well, if you just look very quickly up here, hopefully, the balances are the same. So what that's telling me now is that from the information that we've got, we know that we haven't made any errors in our cash book and that everything is in there. We're just waiting on these timing delays. You will also see bank reconciliations done from the basis of as per the bank statement down to balance as per the cash book. And what you'll notice if you decide to do it that way, we, instead of adding unpresented checks, we less unpresented checks and we add amounts not yet credited. And I'm showing you both ways just because particularly mark schemes quite often do one way or the other. So if we just think about the logic of doing it this way, balance as per the bank statement, well, we need to less unpresented checks because that's money that's going to go out that the bank haven't yet done. So we need to take that $750 off because we know that customers are going to, or suppliers, are going to cash those checks. So That would leave us with a balance of $255. However, we've paid some extra money into the bank. We've paid in total $585, and that would increase the amount of money that the bank actually owes us. So again, balance as per cash book. Well, we can just see from looking here, that was the original balance. So again, it's correct. If it wasn't correct, we'd either need to look for errors or check again to make sure there aren't any missing entries. So common errors, banks do make errors, but for example, we may have made an error and written wrong number somewhere in our cash book. So what we're doing here really is checking the accuracy of our accounts. What I've done, I've given you the answers to what you did last time, and what I want you to do is to have a go at doing the balances as per the cash book, balances as per the bank statement for both of those questions. Good luck with that, and I'll speak to you soon. Bye-bye.